I do think that insurance is really the canary in the coal mine with regard to the climate crisis, and the canary is expiring, and that we are marching steadily towards an uninsurable future in this country. It's gotten so bad that Jerome Powell, the chairperson of the United States Federal Reserve Bank System, testified before the U.S. Senate about 2 months ago that in parts of this country, in parts of the United States, in as little as 10 years, you won't be able to get a mortgage. Why? Because you can't find insurance and or you can't afford the insurance price.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast and YouTube series, Real Estate Market Watch, current events through a real estate lens. Now, the topic of insurance is one that has been emerging with increasing frequency over the last few years from our clients and also anecdotally across the industry. Insurance premiums have skyrocketed across the industry. They have outstripped projections, pro forma projections, having direct negative impact on investor returns. So what's going on in the insurance industry? Well, my guest today is Dave Jones, who is director of the Climate Risk Initiative at the Center for Law, Energy and the Environment at UC Berkeley. And Dave is one of the country's foremost experts in the insurance industry. In fact, he was served 2 terms as California Insurance Commissioner, where insurers collect over $300 billion a year in premiums and have over $5.5 trillion in assets under management, a lot of which is actually funneled into commercial real estate. So there's this entire flywheel, is that the word for it? Flywheel of impact of rising insurance premiums, higher risk, and the indirect impact on commercial real estate of the struggles that the insurance industry are currently facing. So my conversation with Dave, it covers all of these topics and really gives you a deep insight into what's happening, including discussions about uninsurable zones across the country, federal regulations, what kind of impact that is happening, the impact of the recently passed big, beautiful tax bill, insurance companies' retreats from some markets, and the way that different states are addressing the challenge to greater or lesser extent. So if you have not already signed up for or subscribed to my newsletter, just go to GowerCrowd.com and find the show notes page for my conversation with Dave Jones today. And on that page, you will see a subscribe button at the top menu where you can subscribe to the newsletter. I do write detailed summaries of these conversations so that you can access them in written format, as well as distributing tips, tricks, and tactics for capital formation as they occur to me, actually, to share them with you. We also talk about AI once in a while. But anyway, it's all there at GowerCrowd.com. Just hit the subscribe button. All right, let's move on to the important topic of insurance, one that we all kind of throw our hands up in resignation to, I guess, if that's grammatically correct. But let's take a deep dive and learn more about what's going on in the industry and how it could impact you. From Dave Jones, UC Berkeley Law, Director of Climate Risk Initiative, Center for Law, Energy and the Environment. Dave, thank you so much for joining me today. I read that article in the FT that you were quoted in, found it extremely interesting. And I'd like to talk to you about the impact of insurance. It's a big topic, obviously, on the commercial real estate industry. But before we get started, please, can you tell us actually who you are, what you specialize in, and a brief background or a brief outline of your background in insurance? Because I know it's you probably one of the top people in the country to be talking about this subject. So who are you?
Well, it's a treat to join you, Adam, and your listeners, and thanks for the opportunity to do so. I direct the Climate Risk Initiative at the Center for Law, Energy, and the Environment at the University of California, Berkeley. And my focus is on what financial regulators ought to be thinking about and doing as it relates to the impact of climate change on the financial institutions and financial markets they regulate. So what should insurance regulators be thinking about and doing? What should bank regulators be thinking about and doing? What should central banks be thinking about and doing? What should securities and exchange commissions be thinking about and doing as it relates to the impact of climate change on the markets that they regulate? And then, for good measure, are there market-based approaches that can be developed to try to deal with the growing economic and insured losses and financial losses associated with the impacts of more extreme and severe weather-related events?
Now, you've left something out that is extremely interesting. And that was you were the California Insurance Commissioner, weren't you? And the reason this is really interesting, apart from speaking to your background and expertise in this area, is that this is where insurance collectors, according to your bio there at Berkeley, collect $310 billion a year in premiums and have $5.5 trillion of assets under management, a significant proportion of which is actually invested in real estate. So at the ground level, what's happening to real estate actually could potentially have profound implications for how premiums are invested as well and where they go. So it's a big topic. What was it like being the commissioner? Sounds like a very big job, that.
So I did serve for 8 years as California's insurance commissioner. And in the United States, we regulate insurance at the state level and territorial level, unlike other countries like the United Kingdom and France and Germany and elsewhere, where insurance is regulated at the national, or in the case of the EU, the supranational level, if you will. So as an insurance commissioner, you're responsible for licensing and regulating the insurance companies that are selling insurance in your state. A big part of the job is making sure that the company's financial condition is such that they can sustain themselves and pay future claims. Another big part of the job is regulating what's called the market conduct in the insurers, how they interact with businesses and households and individuals in the sale of insurance and payment of claims for insurance. And then I suppose a third part of the job is working with other commissioners across the United States to try to address systemic financial risks that are impacting the insurance industry. So I did quite a bit of that as insurance commissioner in California, pioneering some approaches to address emerging risks associated with climate-driven, severe and extreme weather-related events. And I did some international work as well. I was the founding chair of the Sustainable Insurance Forum, which was a collection of national insurance regulators developing best practices to address growing risks associated with climate change impacts in their respective markets. So it was a terrific job. I loved serving the people of California, and by virtue of the size of California's insurance market, it's the fourth or fifth largest insurance market by premium volume in the globe. You have a lot of reach as the Insurance Commissioner of California, and so you can do a lot of good work to both make sure that insurance continues to be available, but also address some of the frictions that sometimes emerge between insurers and their customers.
That's really interesting. Actually, you used the term there that I didn't expect to hear. I mean, actually, I've read commentary of you using it, so it did take me by surprise. And that is this idea of systemic financial risk, which is a concept that's usually applied to the banking system and less so to the insurance industry. In what way can the insurance industry present a systemic financial risk?
So I think the issue is that more extreme and severe weather-related events are posing systemic risk to the U.S. financial system as a whole, and in particular to United States property and casualty insurers, but not simply those in the U.S. I think this is a global problem. This is not just a Florida, Louisiana, California issue. It's actually a global problem. And if you look at the insured natural catastrophe losses globally in 2024, they were about $137 billion. all in. That's insured losses, not economic losses. Economic losses were probably from natural catastrophes were probably 3 times that. Well, that 137 billion of global natural catastrophe losses driven by climate-related events is a record. It exceeds the rolling 10-year average by about 20%. And the projection is that this year we're probably going to get to 150 billion in insured global natural catastrophe losses. And Swiss Re, the international reinsurer, predicts that there's a 1 in 100 chance, I believe it is, that losses could get to $300 billion, right? So the trajectory is bad. What's happening is that climate change is essentially driving more severe and frequent weather-related events. These are wildfires, droughts, extreme heat, severe convective storms, tornadoes, hail, hurricanes, river flooding, sea level rise, and sea and coastal flooding. And all of those are killing people, injuring more people, causing more property damage, and causing property and casualty insurers to pay out more money. And that in turn, those growing losses globally and in the United States are causing insurers to respond in 2 ways. One is to raise price, and then in addition to that, to not write insurance. And that then has implications for households and businesses and large commercial property owners' ability to afford insurance or even get insurance. And then that has implications for lenders, because lenders, whether they're lending to a home purchaser or a small business property owner who's buying a small business property, or even a lender that's lending to a large commercial property owner, wants to see that there's property and casualty insurance. And as that price of that insurance goes up, and as it becomes harder and harder to get, that then has implications in credit markets for people's ability to access loans, whether it's a home, a small business, or even a large commercial property owner. And then that has flowed through implications to the real economy and to the overall financial system. So there is widespread consensus amongst regulators across not just insurance regulation, but also banking regulation, not just in the United States, but globally, that climate change is posing a systemic risk to the financial system. And that one channel for that risk is through insurance, to lending, also to home and business property markets, and then to issuers of credit, banks themselves, and then potentially to Fannie Mae and Freddie Mac, which, as you know, purchases mortgages from mortgage lenders. And so it has implications throughout the whole system.
Yeah, it's really interesting. And let's unwrap some of these topics, actually. But before we do, you and I started, I was trying to contextualize who's listening. We talked about commercial real estate, investor, professional, and passive investor. And you provided some provisos about our discussion and what the data is actually pointing to as it relates to commercial versus residential insurance. So can you kind of, I hate to ask you to repeat, but you mind getting into that again? The signals are more related to or more clearly seen in residential versus commercial at the moment. Is that right?
So I think that the publicly available evidence of the impact on these more frequent and severe weather-related events as it relates to real estate, the public evidence is more robust in the context of homes and small business properties. But I think anecdotally, there is evidence that the same impact I'm now going to discuss is also impacting commercial real estate and the insurance availability and pricing for commercial real estate, mostly pricing. And then that has implications potentially for credit for commercial real estate as well. But the Dallas Federal Reserve Bank completed a study some months ago where they looked at those areas in the United States where climate change driven extreme and severe weather related events are landing with the greatest severity. Not surprisingly, those are also the areas where insurance prices are going up dramatically because the insurers are trying to cover more losses. And also in those same areas, insurers are not renewing insurance for homes and small business properties, or not writing new insurance as well. And what the study found was that in those areas where climate change is landing with the greatest severity, where it's having the greatest impact on insurance pricing and availability, the study also found that there was a concomitant increase in mortgage defaults, mortgage delinquencies, and mortgage prepayments. So what's going on? So homeowners or small business property owners will take a 30-year loan out. They're required to have insurance. They figured that their insurance price would maybe go up, 5 or 8% a year, and that they could manage that price increase in the insurance. What's happening is insurance pricing is going up 50, 60, 70, in some geographies 200, 300%. And so people then can't afford to cover their insurance costs as well as their mortgage loan payments. And so they're delinquent in payments, or they're defaulting outright on payments, or they're deciding to prepay the mortgage at a loss because they're looking at a future where their insurance price is just going to go up and they can't afford it. So what is also noteworthy is that another study that was done looked at what's happening in Florida specifically, and what's happening in those counties in Florida where hurricanes are landing with greater severity. And not surprisingly, it's in those very counties where insurance prices are going up dramatically and insurance is increasingly unavailable. And what the study found was that mortgage lenders are able to discern which properties are riskier and which properties have riskier insurers insuring those properties. So Florida, as a part of its deregulatory approach to this crisis, has allowed a less robust rating agency to rate Florida insurers. To give you some sense of how well that's gone, 10 out of the last 10 insurance insolvencies in Florida were rated by this less robust rating agency. And so mortgage lenders, it was discovered, are able to discern which properties they're lending to, which are insured by insurance companies that are rated by the less robust rating agency, and they're disproportionately selling those loans to Fannie Mae and Freddie Mac.
Really?
So basically, they're recognizing that climate change through insurance is causing substantial risk to their loans, and rather than hold those loans on their books, they're offloading them to Fannie Mae and Freddie Mac, which means that risk is then borne by U.S. taxpayers, who ultimately are backing Fannie Mae and Freddie Mac. So these are just some concrete examples of how this risk is flowing through the system and how it's materializing. And while there have been less studies done with regard to commercial real estate, impact on insurance pricing for commercial real estate, and impact on credit for commercial real estate, it stands to reason that the same phenomenon is occurring, maybe with slightly less acuity because commercial real estate owners have a better bargaining position vis-a-vis insurance than do individual homeowners and small business property owners. But at the end of the day, you can't beat the math, which is the insurers are losing more money and as a consequence charging more across the board, not just for individual homes, not just for small properties, but also for commercial properties. And this then too can have implications for commercial real estate and credit for commercial real estate as well.
Yeah, fascinating. So let me just paraphrase what I think you just said over there. So banks are divesting of loans that they have brought on board by selling them to the agencies because they are concerned that the insurance coverage that they have on them in the event of some kind of catastrophic event will not actually exist, right? Because
that's right. So their only collateral, of course, is the property, and they require that the property be insured. And if you let your insurance lapse as a home purchaser, the mortgage lender can force place insurance on you. But they're recognizing that some of the insurance that folks have in Florida is from insurance companies that themselves face a greater risk of insolvency. And therefore, that means that if a hurricane hits and the house is knocked down, that their collateral has been knocked down, and there isn't insurance available potentially because the insurance company faces a greater risk of insolvency, as occurred in Florida, where some 12 or so insurers went insolvent when the last big hurricane hit a couple of years ago. So therefore, the collateral is not protected, and the mortgage lender is left holding the bag. So to offset that risk, they're selling those loans to Fannie Mae and Freddie Mac, which is the secondary market, which was created to try to improve the availability of home purchase for families and individuals in the United States by creating a secondary market and kind of priming the pump for more of these loans. But the downside is that the mortgage lenders are discerning which of their loans are riskier because they're insured by insurance companies that themselves face greater risk, and they're selling those to the secondary market, which in turn is backed by the U.S. taxpayer. So, that's an example of a concrete example of how this risk is flowing through and where the risk could end up ultimately, which is on the backs of the U.S. taxpayer. If in fact this phenomenon seen in Florida, and it stands to reason, is occurring in other places as well.
Let's get back to Florida in a second, but before we do, it's this idea that people are paying off mortgages because they can't afford the insurance, mind-boggling, really. So what are they doing? Are they self-insuring? Is basically they're trundling along with no insurance?
Well, they're selling the home at a loss. They're paying off their mortgage, and they're moving. Right.
Oh, I see.
So the mortgage prepayments are not typically people that are loaded with cash and can afford to prepay. They took a mortgage for a reason. They needed the mortgage. But what they're finding is that their insurance price is squeezing them out. They're worried they're going to default, which would mean they could lose the underlying property. So rather than wait for that to happen, they're essentially selling and prepaying the mortgage and potentially selling the house at a loss in order to get out from under it and out from under the mortgage. So, that's a part of this phenomenon. I think the bigger part was the delinquencies and defaults, but all three things are occurring based on this study, and they're occurring with greater frequency in those areas that are hardest hit by climate-driven events, where there's an impact on insurance pricing and insurance availability. And look, I think it's important to note too, this issue is not just limited to Florida and Louisiana with hurricanes and California with wildfires. We're seeing across the United States these catastrophic events landing, killing more people, injuring more people, causing insurers to pay out more. Last year, the insured natural catastrophe losses in the United States were about 110 billion, right? And that's probably the fourth time in recorded history it's ever gotten that high. But about 40 to 50% of those losses were from severe convective storms. Now, if you had asked an insurance professional 20 years ago, 30 years ago, are you worried about severe convective storms? They would look at you blankly and said, what's a severe convective storm?
What is it?
Yeah. Well, it turns out that climate change is not only causing things that have historically killed us to kill more of us, injure more of us, damage more property, and cause insurers to pay out more, but it's essentially creating new things to do that. So severe convective storms are essentially what are referred to colloquially as atmospheric rivers. So as global temperatures continue to go up, the atmosphere retains more moisture, weather patterns are changing. So these large volumes of moisture sit over geography, and it comes down as heavy rain, sometimes coupled with wind. Now that causes flooding, but remember, private home insurers and small business insurers in the United States don't cover flood. They got out of that business in the 60s because they couldn't make money on it. So instead, flood is covered by the National Flood Insurance Program. So the issue with the losses from severe convective storms for private insurers is not flood. It's just damage from rain getting into the house and causing substantial damage. And so some 40%, maybe as high as 50% of the insured nat cat losses in the United States were from these atmospheric rivers, these heavy storms. And those are landing everywhere in the United States, except maybe the desert, right? So it's not like there's some place in the United States where you have a get out of climate change free card where this is not occurring. And so it's not just a Florida, California, Louisiana issue. This is happening with different levels of acuity and severity across the United States. It's gotten so bad that Jerome Powell, the chairperson of the United States Federal Reserve Bank System, testified before the U.S. Senate about 2 months ago that in parts of this country, in parts of the United States, in as little as 10 years, you won't be able to get a mortgage. Why? Because you can't find insurance and or you can't afford the insurance price. And mortgage lenders looking at this risk are saying we're just not going to loan. So this has then real implications, not just for the financial system, but also for the underlying real economy. And could, as the Financial Times article that you alluded to earlier walked through with various experts, including myself, could result in substantial reduction in real economic growth and in particular geographies, catastrophic events which have even more acute impacts on the local economy.
It's not fascinating. The idea of uninsurable zones. Is there a relationship directly between, as you watch the signals, between unaffordable single-family home insurance and rising premiums and commercial real estate premiums? Do they rise in lockstep?
Well, it's a little hard to say because the premiums associated with home insurance and small business insurance are filed, the rates are filed with the state insurance regulator. The rates associated with commercial, particularly large commercial property insurance, are not filed, right? So there's less evidence, but everything that I've seen indicates that those rates are going up too, particularly for commercial properties that are in areas where these climate-driven events are landing with greater severity and or acuity. And so I don't think this problem is just limited to homes and small businesses. It's a problem for commercial enterprises also. Now, commercial enterprises have more capacity potentially to pay for rising insurance costs, but at some point it begins to have an impact on the bottom line of commercial property owners or businesses that are operating in commercial properties as well. And it's also possible that in some geographies, certain sorts of risks, even in the commercial property context, insurers will exclude coverage for because they just can't make a buck insuring even commercial properties in some geographies based on the nature of the risks that are landing there. I don't think that those exclusions have materialized substantially in the commercial property insurance context yet, but they certainly have in the home insurance context, and you can see a direct line that could eventually materialize in the commercial property insurance context as well.
Well, I promise you that I give you an actual example. And I'm going to do so to tee up my next question. And that is, we have a client in Florida who you've talked about Florida a few times. They're a major skyrise office owner with, I don't know, 4 million square feet or something. I mean, fairly large for the state. And one of their buildings, he was telling me, their insurance premium for that building went up from $300,000 a year to $1.2 million overnight. That's straight off the bottom line. It is accretive to nothing, right? Basically, it's just cost. And you mentioned that states are taking different approaches to this problem. So let me ask you this. How are states, agencies, and other entities or people actually addressing this problem? What is the solution? Is there a solution at the end of the day?
Well, I think fundamentally you have to stand back and say what's driving this. And it's global temperature rise, and that's driven by emissions from fossil fuel companies and other major greenhouse gas emitters. So, you can do some things to address the symptoms, but what's the cause? So, number one, I think we've got to accelerate the transition away from fossil fuels and other greenhouse gas emitting industries. But beyond that, there are some things that can be done in terms of adaptation and resilience that help to reduce the risk and magnitude of loss. So, for example, in the wildfire context, spending money managing the forest and reducing the volume of fuel in the forest, not by clear cutting, but by introducing controlled fire or prescribed burns, as well as thinning. Managing the forest the way that nature used to manage our western forests before 120 years of fire suppression. It used to be that fire was a routine part of the ecology of western forests. It would burn out a lot of the vegetation. And so instead of these major mega fires, you would have low-lying fires on the ground that would burn out smaller trees and vegetation. Now, we suppressed fire in our western forests for about 120 years. They're choked with fuels when there's an ignition. And when as a result of drier conditions, higher temperatures, more transpiration, the vegetation's a lot drier. You have these mega fires that get into the crowns of trees. So the state of California has appropriated $3.6 billion the last couple of years to do more aggressive management of the forest, not just private forest, but also federal forest. About 60% of the forests in California are federal forests. So there are these interventions that can reduce the background risk. There are things you can do at the property level. Home hardening and defensible space are ways to reduce the likelihood that you will suffer a loss. Commercial properties, there are things that I'm sure insurers are telling commercial property owners they can do to try to reduce, adapt, and provide for more resilience. The challenge is that with regard to home insurance and small business property insurance, the insurers by and large are not accounting for property, community, and landscape scale adaptation and resilience in the models they use to price and write home, small business insurance. And that's very frustrating. So you can be, say, on the coast of Florida, and you meet the fortified home standard, you do everything the experts tell you and spend a lot of money to keep your roof from blowing off, but it doesn't necessarily mean they're going to write you private insurance, or that if you get it, that the price is going to reflect that. So that needs to change. The state of Colorado enacted a law just this year, first in the nation, that requires insurers in Colorado to take into account in their pricing and underwriting for homes and small businesses the risk reduction associated with proven, empirically based property, community, and landscape scale adaptation resilience. And I think other states are going to do the same to the extent that insurers don't take this on voluntarily. In the commercial context, commercial insurers, because the accounts are bigger, some commercial insurers have engineers on board that actually work with the customer to look at adaptation and resilience. So I think there's a little more opportunity there and evidence there that insurers are taking adaptation and resilience into account. But even there, it doesn't look like they're taking landscape scale investments in adaptation and resilience into account. So the second thing that needs to be done, first is address the root cause. Second is invest more in adaptation and resilience. That's going to be public money and private money, but make sure insurers are taking that into account in their pricing and underwriting. The third path that states like Florida are pursuing is to deregulate the market. Right. And I submit that I don't think that's going to be the path that ultimately will be successful. So in Florida, rates are 4 times the national average. They've undertaken a number of things at the request of the insurers to substantially deregulate the market. And yet, notwithstanding that, the national branded home insurers are not writing home insurance in Florida.
Why isn't that working, Dave? Dave, first of all, what is deregulation? What does that mean exactly? And why is it not working?
Yeah. So I'll give you some examples. One is rates 4 times the national average is one vestige of deregulation. The other is, and we talked a little bit about this, but allowing a less robust rating agency to rate the insurers that you then allow to sell insurance in the state.
I see.
A third is they adopted laws in California and Florida, that substantially reduced third-party lawsuits against insurers. They've also adopted 2 taxpayer-funded reinsurance facilities to provide cheaper reinsurance to private insurers in Florida. They've also limited private insurers' exposure to their insurer of last resort, Florida Citizens, running out of money. They've done a variety of things at the request of the insurers that are substantially designed to reduce burdens on insurers, allow them to charge highest rates in the nation, and so on. And yet, notwithstanding that, the national branded carriers are not writing in Florida. Why? Because the background risk is too great and growing with regard to hurricane severity. And so even with all of these things, even the price is 4 times the national average, they can't make a profit writing in Florida because the background risk year after year keeps going up because global temperatures keep rising. And so I think that that is evidence that we're ultimately not going to be able to price increase and deregulate our way out of this problem. We've got to address the root cause of the problem. But having said that, in the short or midterm, more price for insurers can help keep insurance, relatively speaking, more available in some geographies. It's just that in the long run, it's going to get outrun by the rising global temperatures and rising risks associated with that. And so it's not a long-term strategy for insurance availability and affordability. I do think that insurance is really the canary in the coal mine with regard to the climate crisis, and the canary is expiring, and that we are marching steadily towards an uninsurable future in this country, just as Jerome Powell indicated when he testified with regard to mortgages availability in parts of this country in as soon as 10 years. So it's a problem, and one that continues to grow, and it's not limited to just specific geographies in the United States, different levels of acuity. But this past year, I think it was in Iowa, 3 or 4 insurance companies went insolvent in Iowa. So this is not a problem just in the coast or the west of the United States.
Okay. I'm going to betray a little cynicism, which lies at the core of the way I view the world. At the moment, there is a perfect solution to this whole thing, and that is to prevent data from actually being assembled and analyzed so that we don't know it's happening. He said, tongue-in-cheek. And in fact, the current administration, the Trump administration, is doing exactly that, isn't it? It's cutting NOAA, FEMA, Federal Insurance Office, reducing ability for professionals like yourself to access data, to analyze it. Is that, I mean, it's something I actually have been interested in. It's this idea of curtailing availability of federally produced data. It's just fascinating to me. What do you see in that? Is that notable? Is it impactful? Does it hurt? Or is it a white elephant, something not to bother with and worry about?
Well, it's not helpful. It's not helpful for private insurers to have less access to credible, robust data. And so it is a problem. Although insurers also have access to other sources of data with regard to these phenomena. And they also have very sophisticated catastrophe models that are forward-looking and probabilistic that require data, but they have access to plenty of data out there to continue to recognize that this is a big problem and that in some geographies it doesn't make sense for them to keep writing insurance. So it's not helpful. It certainly is problematic, but insurers are rational economic actors. And even if they didn't have plenty of data, which they do, what they're likely to do in the face of the federal government cutting off data is to take a conservative, rational economic approach and price even higher and write even less. So sticking our head into the sand, as the federal administration appears to be doing, isn't going to solve this problem. There's plenty of data out there. The insurers have access to data. They have a sophisticated modeling capacity. They know this is a growing problem. And they know that their response is going to be writing less insurance and pricing even higher where they're writing it. It's not helpful to not have access to this data, but it's not going to stop them from responding in a rational economic way.
So we are sitting here. We should probably move to wrapping up, actually. It's gone incredibly quickly, our conversation. Thanks so much, Dave. I really appreciate it. But we are sitting here the day after, actually, not literally, because there's been a weekend in between. But on Friday, the big, beautiful bill was passed. It was signed into law by the president. What's in that we should be paying attention to from an insurance perspective, particularly as it dovetails into the commercial real estate industry?
Well, we've talked already about the cuts to and rescissions of funding for federal scientific agencies, and so there's a lot of that in the bill, and that's a problem. I think also I sort of lost track, but I don't think FEMA gets abolished in the bill. There was an effort by the president to include that in the bill. I don't think that ended up in there, but certainly the president's announced intention to get rid of FEMA is a big problem. Although FEMA doesn't help you rebuild your home or your business, they're incredibly important, and the funding they provide is incredibly important for public infrastructure, which is necessary for people to rebuild and rebuild their home and their business, and necessary for business to flourish. So the president's continued disdain for FEMA and his suggestion that states should bear the burden of these disasters, I think does not bode well, particularly for poorer states, in terms of their ability to recover from these disasters and the ability of their economies to recover and the ability of their commercial property owners to recover as well. Because ultimately you need roads, curbs, sidewalks, sewer systems, water systems, all of which get impacted. And if those aren't rebuilt, then that has an implication on the viability of the commercial property, just as it does for homes and small businesses. So that's not good. And I think too, I suppose the other aspect of this in terms of implications for lending is that the president is making a wholesale assault on independent financial regulatory agencies. So whether it's the FDIC or the OCC or the Federal Reserve or the SEC or the other regulatory agencies, he has sought to assert his own policy prerogatives in these agencies, reduce or eliminate their independence, and also keep them from considering the kinds of risks that have been at the heart of this conversation. And I think that's a big problem, because that means then that federal financial regulators are less equipped to see around the corner as to when the next big financial crisis is going to come. And I think that then has implications for all of the United States, its entire financial system, and as well, underneath that, lending to borrowing by commercial property. And so eliminating the ability and independence of federal financial regulatory agencies to consider these risks is a real problem. And again, sticking our head in the sand isn't going to change the fact that things are getting worse from a risk perspective, and that has real implications for the financial system. So I think that's a third aspect of the bill, but also more broadly, the administration's policy with regard to financial regulation.
Dave, I've got some rapid fire sign-off questions that I'd like to ask you. But before we go to them, my focus is on commercial real estate. And so I have steered our conversation into that direction. But is there anything that you would like to say or contribute to this conversation that I've not asked, or that is particularly important to the industry, that maybe doesn't have an immediate direct impact on commercial real estate or real estate in general?
No, I think you've been very thorough, and I've been able to weave into the conversation the sort of the broader systemic implications of this problem.
All right, thank you. I've kind of felt, I was just a little concerned that I was kind of arm twisting you into an industry that maybe wasn't your primary focus. Let me ask you 3 sign-off questions, and I'm going to have to adapt these actually. But what are the market signals? What are the signals, the market signals that you watch that either that reinforce the thesis that you have about what's going on, or alternatively that give you pause for thought?
Well, I think insurance pricing and insurance non-renewals are 2 important market signals that I and others are paying attention to. And prices going up, and there are increased non-renewals and increased declinations to write new insurance in the home and small business property context. And as your anecdote pointed out, I think that by my math, that was a 400% increase in rate for a large commercial property owner in Miami.
Yeah, very significant.
That is a big problem, right? And then I think looking at what banks are doing, generally speaking, in terms of how they're assessing these risks, how they're pricing these risks, and if they're taking on these risks, what they're doing in terms of trying to mitigate the risk to them, just as we've discussed in the mortgage lending context, the evidence that mortgage lenders are offloading that risk to Fannie Mae and Freddie Mac. I think, too, looking at the global insured natural catastrophe losses as well as economic losses and the trend line there is important to pay attention to. Looking at reinsurance pricing, which has gotten a little bit softer recently, but has historically been going up because of the increased losses that reinsurers have been facing. That's another hallmark of a degree of challenge here. And then I think, at some point, rating agencies that are rating corporate securities as well as public debt are going to start catching up as well. And so what am I talking about here? Well, a lot of cities and counties and states issue bonds, and those bonds tend to be looked at as very safe and secure. But if you're in a city that's going to be underwater in 30 or 40 years, it may not be the case that the bond you issue is that secure. Or if you're a city in the midst of an area prone to wildfires, your ability to debt service and pay the bondholders may be challenged by the fact that you have a major wildfire that destroys substantial parts of your city, reduces assessed property values to zero. You then can't collect from property owners the money you need to debt service on the bonds you've issued. That then has flow-through implications for the bonds and then the bondholders, right? So we're starting to see rating agencies begin to catch up a bit and begin to downgrade jurisdictions that are facing these risks. I think there's a huge lag there. For whatever reason, they've not been doing it as much as they should, but that's another aspect of this to watch out for. And then there was a study released by First Street Foundation, I think last year, that looked at the issue of whether there's a housing price bubble, because housing prices are continuing to lag behind actually taking up the risk of loss that those houses face in various geographies. In some cases, because of the mismatch between supply and demand, like in California, we're about 2 million housing units short of what we need. And as a consequence, the impact of insurance pricing isn't really showing up yet in housing pricing. But this First Street Foundation study looked out over 30 years and looked at various perils and concluded that there is hundreds of billions of dollars, maybe as much as $1 trillion, in housing overpricing because the housing prices don't reflect the underlying risk of loss of those homes. So that's another potential signal and indicator to keep close attention to as well.
Dave, thanks so much. Let me ask you one final question. And that is, okay, so you've talked about systemic risk. You've outlined all of these other risks and trends. So what is the time scale we're talking about? I mean, we're beginning to see the early signals of stress on the insurance industry, for sure, particularly in residential, less so in commercial. But for systemic risk, what are we talking about in terms of time scale? Is this generational or is this later this year kind of challenge?
Well, I think it's happening in real time now. I mean, after, I think it was Hurricane Ian, don't quote me on that, I can't keep track of them all, but in Florida, there were some 12 insurance companies that went insolvent. That was a huge problem for people that thought they had insurance. It had real implications for their ability to recover and for the economies in which they live, in which their businesses operate to recover. I think I mentioned there are some 3 or 4 insurance insolvencies in the Midwest just last year due to severe convective storms. So it's happening in real time. It's only going to get worse. Will there be one event that brings the whole house of cards down, much as the 2007-2008 crisis? Potentially, but I think it's more likely that this will be a steady glide into uninsurability with implications then for credit, for the real economy, for growth in these areas where climate change is landing the hardest. And so, and I think where there might be a trigger is if rating agencies finally catch up and say, wait a minute, it suddenly dawned on me as a rating agency that all this debt that's been issued by City X, and City X is going to be underwater in 20 years, they may not be able to repay it. I'm going to downgrade that debt. If the rating agencies start doing that in a more deliberate way, which they should, that could then have substantial ripple effects through the broader economy and financial system. But I think it's more likely that it's going to be a steady march to uninsurability, a steady march to credit market impacts, a steady march to real economy impacts, as opposed to one major catastrophic event that brings the whole house of cards down.
Dave Jones, UC Berkeley Law, correct? Director, Climate Risk Initiative at the Center for Law, Energy and the Environment. Hopefully I got that right. Thank you so much for joining me today. It's been a real pleasure.
My pleasure, Adam. Thanks for reaching out, and appreciate the chance to talk to you and your listeners.
All right, that was Dave Jones, UC Berkeley Law and Director of the Climate Risk Initiative. Thank you so much for joining me, Dave. It was a real pleasure to meet you. I appreciate you having taken the time out of your day. I did enjoy that article in the Financial Times. It was very long and detailed. And your quote, thanks for joining me basically today to dive into that in some considerable detail as we did. And thank you to dear viewers and listeners for joining us today. It is interesting to unwrap these, line items essentially in our pro formas, but line items that are becoming increasingly impactful on the bottom line and potentially also, dare I say it, catastrophic to the viability of a deal that you might be looking at. If the insurance premiums are too high, you might just walk away. That is of profound significance. And if you've not already subscribed to my newsletter, please go to gowercrowd.com. There's a big button there that says subscribe. It's totally free. You can always unsubscribe, but you will get early notification of these podcasts, detailed written summaries, and access to other tips, tactics, and techniques, including those that we're exploring in AI as you try to raise capital for your next deal. All there at gowercrowd.com. Just hit the subscribe button. Okay, that's it from this episode. Thanks so much for joining me. I look forward to seeing you next time. But for now, this is Adam Gower signing off.